Yeah. So in this section, we want to capture why the last 21 months have been first bad for India, and also then talk about what lies next in front of us. So, covering the first part in detail, last 21 months have been brutal for India. Some people, so when we compare India to, let's say, indices, countries like South Korea, Japan, US, China, Brazil, almost all the indices have outperformed India. India has been the worst performing market over the last 21 months. Some say this is because India does not have an AI play. Some say this is because India was expensive. We believe in the latter, which is that India was somewhat expensive, and the growth that we've seen in the Indian companies has not been commensurate with what the valuations they were at over the last 21 odd months. And hence, India has seen a both time and value correction over the last 21 months. Anubhav, moving to the next slide. Uh, the correction has been fairly brutal. If we were to basically consider this, we've analyzed a universe of 2,000 odd listed companies. And we can say that if you look at this particular slide in greater detail, you can see that despite reasonable or okay earnings growth, roughly 80% of the companies have actually delivered subpar returns out of the 2000 listed company universe in India, which means that one in five companies have given above par returns in the last 20 odd months. And hence, stock picking has been very difficult, and it has been very critical to identify the right companies with the greater detailed research and identify good founders. Then only you would then only the chances that you would be above par in returns are there, and hence it has been fairly tough to even deliver that. Moving to the next slide, Anubhav. So we want to capture the same data with a different analysis on indices. First thing I want to capture is that the earnings growth in India has happened over the last 24 months. If you see Nifty 500 EPS growth, roughly 16%, Nifty mid cap EPS growth has been 60%. If you look at Nifty micro cap, the earnings growth has been 7%. Despite that, if you look at the returns have been either in red or barely zero, basically, or thereabouts. This is largely because most of these indices were trading well above their long-term median 10-year average valuation levels back in September 24. And as a result of which, despite reasonable to medium earnings growth, uh, the uh, the valuations have corrected. There's been either a time correction or let's say a value correction in all of these basically indices as well. So again, capturing the same point with a different slice. Moving to the next section, Anubhav. In this slide as well, we want to capture again the same point that, but by sectors now, that again, in the last 21 months, what we've seen is that sectors that were expensive roughly back in September 24 uh, and have grown medium to average in terms of their earnings. Almost all of those sectors have delivered negative returns during this particular period. Whereas on the flip side, sectors which were not expensive or sectors were medium in their valuation range, basically, and have delivered average to above average earnings growth, have been the ones which basically um, uh, have delivered positive returns. So if you see the chart on the extreme right, the sectors like PSU banks, sectors like healthcare, sectors like metals were sectors basically which were at the bottom quartile of their valuation. So with medium to above average earnings, their returns have been positive. If you look at the index from a larger perspective, the sectors which represent the index by and large, IT, FMCG, private banks, uh, even auto, basically consumer durables, these add up to form a large part of the index. Almost all of them have delivered negative returns. So therefore, again, stock picking has been difficult, and focus on individual companies, focus on individual names has been the mantra to deliver above average or positive returns.